Over $300 billion in market value just evaporated from tech stocks this week. Nobody's talking about how quickly this happened. Your money is directly exposed to this volatility right now. This isn't just a blip. It's a seismic shift shaking the foundations of the tech world. You'll soon understand why the biggest names are struggling. We'll expose the real reason behind a massive AI company's secret delay. Plus, you'll discover what this means for your personal investment strategy. This isn't just about headlines. It's about your financial future. Are you prepared for what's coming next? Or will you be caught off guard? Here's the thing. The stock market today is in a serious slide. The Dow, S&P 500, and NASDAQ all slumped hard. This isn't a small dip. It's a full-blown correction for many tech investors. On Friday, June 26, 2026, U.S. stocks were incredibly volatile. A major report dropped. It rattled chip stocks and the broader tech sector. The tech-heavy NASDAQ composite, or just NASDAQ, hovered near the flat line. This index tracks hundreds of tech companies. The S&P 500, which follows 500 large U.S. companies, also struggled. Both closed lower Thursday. That was their fourth straight down day this week. The Dow Jones Industrial Average, or simply the Dow, includes fewer tech names. It also saw sharper losses earlier in the session. Now pay attention. The biggest news driving this fear? A potential delay for OpenAI's initial public offering. An IPO is when a private company first sells shares to the public. OpenAI, the creator of ChatGPT, is considering pushing back its mega IPO. A New York Times report cites 2027 as the new target. This is a huge deal. OpenAI had already submitted a confidential IPO filing to U.S. regulators. The reasons for the delay are critical. Some point to the pop and drop in SpaceX after its own IPO. There's also general choppy trading in AI stocks. Let me break this down. The AI trade was already under pressure. Bets are growing on a Federal Reserve interest rate hike this year. The Federal Reserve, or Fed, is the U.S. central bank. They control interest rates. A hot May reading of the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, PCE, kept that prospect alive. High inflation often leads to higher interest rates. This makes borrowing more expensive. It hurts growth stocks like tech. And get this, concerns are also mounting over skyrocketing component costs. Memory and storage components are getting pricier. This hits device makers hard. Apple, APL, recently raised prices on its MacBooks and iPads. Memory chip maker Micron's, MU, stellar earnings report showed the squeeze will continue. Another big mover? Oil prices. Brent crude futures sank to about $73 a barrel. WTI crude traded below $70. That's a 3% slump. Tanker traffic continues in the Strait of Hormuz. This is despite an attack on a container ship. The U.S. and Iran agreed on a 60-day ceasefire. Still, turmoil reports in the key waterway persist. Tehran is eyeing transit charges. Look, it's not just OpenAI. On Semiconductor agreed to buy Synaptics. This all-stock deal is valued at $7 billion. They aim for global leadership in intelligent systems for physical AI. FedEx Freight delivered solid earnings. But Nike got a downgrade ahead of its earnings next week. KeyBank moved the stock to hold from buy. They cited a longer-than-expected turnaround, especially in China. All these individual pieces matter. They paint a clear picture. The tech sector is facing a perfect storm. It's a mix of IPO delays, rising costs, and macroeconomic pressures. This isn't just daily noise. We're witnessing a critical moment. It will shape the future of investing for years to come. To understand why a single report about OpenAI is sending shockwaves through the NASDAQ today, we have to look at the trajectory of the last few years. 5 years ago, the market was driven by a different kind of growth, but the seeds of this current volatility were sown back in 2024. That was the year of the great AI awakening. When the world first realized the scale of generative intelligence, capital flooded into the chip sector. We saw a massive surge in demand for high-end GPUs, which pushed valuations to heights we hadn't seen since the dot-com era. By 2025, the hype cycle reached a fever pitch. Investors stopped looking at current earnings and started betting on the projected revenue of 2030. This created a dangerous feedback loop where any hint of a delay in a major IPO, like OpenAI's, now feels like a systemic failure rather than a simple corporate scheduling change. The cause and effect here is straightforward. The massive investment in infrastructure led to a supply chain squeeze. By early 2026, the cost of memory and storage components skyrocketed. This is exactly why we are seeing Apple raise prices on MacBooks and iPads right now. When Micron reports stellar earnings because of these price hikes, it sounds great for the chipmaker, but it is a warning sign for the device makers. The cost of building the hardware necessary to run these massive models has become a drag on the very companies meant to deploy them. We moved from a period of pure discovery to a period of expensive implementation. The market is now realizing that the road to monetization is much longer and more expensive than the initial hype suggested. The delay of the OpenAI IPO until 2027 is the catalyst that is forcing investors to confront this reality. It signals that the leaders of the revolution are hesitant about the current market appetite. We are no longer in the honeymoon phase where every announcement pushes stocks higher. Now, the market is demanding actual margins, and the rising cost of components is eating those margins alive. This transition from speculative growth to operational reality is where the current friction is coming from, and it is why the indices are sliding today. Some critics will tell you this is just another bubble bursting, and they will point to the 2000.com crash or the 2008 financial crisis. In those cases, the pattern was the same. Irrational exuberance followed by a sharp correction when the underlying assets didn't support the price. The 2000 crash happened because companies with no revenue were valued at billions. Today, the giants like Nvidia and Microsoft actually have the cash flow, but the valuation gap is still immense. However, there is a fundamental difference this time around. Unlike the 2000 crash, we aren't dealing with imaginary products. The utility of this technology is real and integrated into the global economy. What is genuinely new is the sheer speed of the hardware cycle. The shift toward physical AI and intelligent systems is happening at a pace that makes previous industrial revolutions look slow. We aren't just talking about software. We are talking about the fundamental restructuring of how hardware is manufactured and deployed. The volatility we see today isn't a sign of failure, but a sign of a market trying to find a sustainable price for a technology that is evolving faster than the accountants can track. We are seeing a clash between the long-term potential of the tech and the short-term pressure of interest rate hikes and inflation gauges. The Fed's preference for higher rates is creating a gravity that these stocks can no longer ignore. The tension between the promise of 2027 and the costs of 2026 is creating a gap that is currently being filled by red candles on your screen. But to truly understand if this is a crash or a correction, we have to look at the balance sheets. I'm going to get into the real numbers next. Let us look at the cold, hard data because that is where the truth hides. Here is what the data actually shows. First, we have the Dow and the S&P 500 both hovering around a 0.1% gain, which in trader speak is essentially a stalemate. The market is flatlining because the optimism is being canceled out by fear. Then we look at the energy sector where Brent crude sank to about $73 a barrel and WTI crude is trading below $70. This 3% slump in oil suggests that despite the geopolitical noise in the Strait of Hormuz, the market is betting on a ceasefire rather than a supply shock. But the real story is in the tech valuations. OpenAI is reportedly pushing its IPO back to 2027. That is a 3-year window of uncertainty for a company that is essentially the bellwether for the entire AI trade. Most people do not realize that this delay is not just about timing. It is about the valuation gap. When you look at ON Semiconductor paying $7 billion in an all-stock deal to acquire Synaptics, you see a desperate race for scale in physical AI. This is not just a purchase. It is a strategic hedge against the rising costs of memory and storage. Apple has already raised prices on MacBooks and iPads, which is a direct signal that the input costs for hardware are spiking. Micron's earnings confirmed this squeeze, proving that the cost of memory is no longer a rounding error, but a primary margin killer. We also have Nike facing a downgrade to a hold rating from KeyBank, while Bank of America is pushing FedEx's price target up to $187, implying an 18% upside. This divergence tells us that the market is not crashing across the board, it is rotating. People assume that a tech slide means the AI bubble has burst, but the data suggests otherwise. The correction is not about a lack of demand for AI, but about the cost of delivering it. We are seeing a shift from the speculative phase where any mention of a chatbot sent stocks higher, to a fundamental phase where the market asks how much it costs to build the server and who is paying for the electricity. We are moving from the era of the dream to the era of the invoice. And on the bull side, the path to victory is clear. For the bulls to win, we need to see a cooling of the personal consumption expenditures index and a pivot from the Federal Reserve. If inflation settles and the threat of further interest rate hikes evaporates, the cost of capital drops, making those long-term 2027 projections for OpenAI actually achievable. The bull case relies on the idea that the current slide is a healthy shakeout. If SpaceX successfully launches its Starlink mobile service for U.S. consumers, it creates a new revenue blueprint for integrated AI and connectivity that could lift the entire sector. In this scenario, the current red candles are just a discount for investors to load up before the next leg up. However, the bear case is far more sinister. The bear sees a systemic failure where the skyrocketing cost of components makes hardware margins unsustainable. If Apple's price hikes lead to lower consumer demand, the chipmakers like Micron and onsemi will see their orders crater. If the OpenAI IPO delay is a sign that the private valuations are vastly inflated compared to what public markets will tolerate, we could see a massive devaluation across all AI-adjacent stocks. We are talking about a scenario where the AI trade doesn't just correct, but collapses as the reality of the 2027 timeline reveals a decade of spending with no immediate profit. A prolonged downturn in the trucking cycle could further drag down names like FedEx, creating a broader economic drag. We would be looking at a lost year where the hype cycle ends and a brutal period of consolidation begins. It is a battle between the vision of a transformed economy and the reality of a balance sheet in the red. So which side is right? That depends on what you do with this next. So which side is right? That depends on what you do with this next. Now, let's talk about what this means for you, directly impacting your savings, your portfolio, and even your future income. If you're a long-term investor, the current market turbulence, with indexes like the Nasdaq hovering near the flat line after 4 straight days of losses, presents a critical inflection point. If your portfolio has a significant allocation to tech, particularly those high-growth, no-profit names, you might already be looking at a 10% to 15% drawdown in those specific holdings. But here's the silver lining. A potential delay in a mega IPO like OpenAI's could signal a much-needed cooling period, creating opportunities to dollar-cost average into established, profitable tech giants or diversify into more defensive sectors that have been overlooked. Don't panic if you see a 5% daily swing in your overall portfolio. View it as a chance to rebalance. For the short-term trader, volatility is your playground, but it's also a minefield. With the Nasdaq seeing daily swings that can exceed 2% in either direction, and individual chip stocks like Micron experiencing wild rides, your precision and risk management need to be impeccable. Tighter stop losses, perhaps at 3% to 5% below your entry price, are non-negotiable. This isn't the market for wild bets. It's for calculated, quick trades, potentially even shorting overextended names if you're comfortable with that strategy. Finally, for those of you primarily focused on protecting your savings, the prospect of continued interest rate hikes, fueled by stubborn inflation like the hot PCE reading, means your cash sitting in a traditional savings account is losing purchasing power. With inflation running around 4 to 5%, your $10,000 in savings is effectively shrinking by $400 to $500 a year. Consider high-yield savings accounts or short-term treasury bills, currently offering yields around 5.25%, to at least keep pace. This market environment isn't just about gains, it's about capital preservation and strategic positioning. So, what should you do in the next 90 days? Here is your actionable plan. First, rebalance your portfolio. If your exposure to high growth and profitable tech or speculative AI plays exceeds 30% of your total equity allocation, consider trimming 5% to 10% of those positions and reallocating to cash or dividend-paying blue-chip stocks by July 20th. This isn't about abandoning innovation, but de-risking. Second, fortify your emergency fund. Ensure you have at least 6 to 9 months of living expenses, aiming for a minimum of $20,000 if you don't already, secured in a liquid, high-yield savings account by August 15th. This buffer is crucial for weathering any unforeseen income disruptions or market downturns without being forced to sell assets at a loss. Third, implement disciplined stop losses. For any individual stock position you hold, especially in the more volatile sectors, set a hard stop loss at 8% below its current market price. For instance, if you own a stock trading at $100, place an order to sell if it drops to $92. This will protect your capital from swift, unexpected declines. Fourth, dollar cost average into diversified ETFs. Commit to investing a fixed amount, say $750 to $1,500, into a broad market index ETF like SPY or a global equity fund every 2 weeks through September 30th, irrespective of market movements. This strategy removes emotion and capitalizes on potential dips. Finally, review your income streams. If your primary income feels vulnerable, actively explore a secondary income source or skill that could generate an additional $400 to $600 per month by October 1st. This could be freelancing, consulting, or developing a small side business. Now, let's talk about 3 key indicators to watch in the next 90 days. First, the S&P 500. If the S&P 500 consistently closes below 4,800 for 3 consecutive trading days, that is your signal to significantly reduce speculative exposure and increase your cash holdings. Second, the 10-year Treasury yield. If the 10-year Treasury yield climbs above 4.85% and holds there for at least a week, that is your signal to expect continued pressure on growth stocks and potentially tighter credit conditions across the board. Third, Brent crude futures. If Brent crude futures fall below $68 a barrel and remain there for more than 5 trading days, that is your signal that global demand is weakening, pointing to a potential broader economic slowdown that could impact corporate earnings. Understanding these signals is paramount. The big picture is coming up next. What we're seeing today isn't just a knee-jerk reaction to a single IPO delay. It's a symptom of a much larger economic recalibration. For years, the market has rewarded aggressive growth, often fueled by easy money and the promise of future innovation. But as the 10-year Treasury yield stubbornly stays elevated and the cost of capital continues to rise, the market's appetite for speculative, long-duration assets is clearly waning. This isn't just a tech sector wobble. It's a reevaluation of the entire growth paradigm. We're witnessing a critical inflection point, moving from a period of unbridled optimism in future earnings to a more sober assessment of present-day profitability and sustainable free cash flow. This shift is characteristic of a maturing market cycle, where the early-stage exuberance gives way to a more discerning, value-oriented approach. Investors are no longer just chasing narratives. They're demanding tangible returns and robust balance sheets. This repricing isn't limited to public markets either. The tremors from delayed IPOs, like what we're seeing with OpenAI, are sending ripple effects through the private equity and venture capital ecosystem. The era of sky-high private valuations without clear paths to profitability is drawing to a close. My bold prediction for the next 12 to 18 months is this. We will see a significant rotation of capital out of highly speculative and profitable growth names, particularly in the software and AI infrastructure sectors, and into established, dividend-paying companies with strong free cash flow and a global footprint. Think mature industrials, healthcare giants, and consumer staples. These sectors, long overlooked, will become the new darlings as investors prioritize stability and consistent returns over exponential but uncertain growth. What most people miss is that this isn't a temporary blip. It's a fundamental resetting of valuation metrics driven by a persistently higher interest rate environment and a more constrained global liquidity picture. The market is finally waking up to the true cost of capital, and that changes everything. So, to quickly recap, the 5 biggest takeaways from today's The next 90 days are going to be critical. We are at a pivotal moment where understanding these macro currents, and not just daily headlines, will be the difference between protecting your capital and seizing new opportunities. Don't get caught flat-footed. Stay informed, stay strategic, and remember that informed decisions are your best defense and offense in any market. If you found this breakdown valuable, subscribe. We drop new finance videos every day. And watch our other videos to stay ahead of the market. Follow for more information.